Good afternoon this Thursday, September 21st. Well, the Evergrande story overwhelmed the grain market again this week on Monday with soybeans declining 20 cents, but recapturing almost half of those losses today on Chinese buying, none other, as they took advantage of their own decline, which we know Evergrande is not going to be the end of buying of grains from China. They're not going to go into a depression, or a recession will likely be avoided as China will step in through their central bank, which their government controls their central bank. Unlike in the United States, we gave control of our money to a private institution called the Federal Reserve, who runs our economy essentially. They're not going to let Evergrande cause contagion to spread throughout their country. They're too prideful to let that happen, by the way, and they desire their economy overtaking the United States. And so with that, this grain bust that we have seen is just another opportunity for end users to buy up, because what we do know is yields are not coming in on corn to support the USDA's recent 176 bushel plus per acre expectations. Even the early start on soybeans don't suggest that soybeans are going to maintain the USDA's near 51 bushel yield guess. If anything, it's going to be under 50 bushels, and corn will likely be back under the August yield guess of 174. This means tightening carryouts, and we haven't discussed the new buying we're going to see in corn beyond what the USDA has planned. First off, Canada is going to be here for more corn than originally they buy. And Brazilian buyers that are being displaced and will be displaced, they're going to be buying our corn as well. There is a lot of adjustment to take place for corn and especially soybeans on the September 30th stocks data, as the USDA still is carrying a carryout number they can't justify as high as it is. What does this all mean? This means that the price decline that we've seen when corn was trading at $5.50 at the midpoint, late August, soybeans were trading at $13.40. We're going to see a resurgence back to those values. The Hurricane Ida and, conveniently now, the Evergrande story helped crush the grain markets for end user buying right in the front of harvest. And it's not going to stay long, because the reality of a smaller crop is going to filter in. Now, wheat. Wheat had recently showed promise last week that it was going to continue higher, just to get crushed 30 cents in 3 days. Well, it was tied to the reality of Russia lowering its export tax and the U.S. missing out when we thought we had a Moroccan trade deal. The wheat deal fell through, and so the market just went into liquidation with corn and soybeans in panic mode today. I'm going to walk you through some charts, and I'm going to start specifically with wheat. Are we even in a bull market? Well, I'm going to answer that question. This is Kansas wheat. We're going to go back 2 years to August. This is the daily continuation chart. And I want you to note the surges, the legs we have uptrending ever since the double bottoms we had in 2019. We're walking out a series of wave higher movements, and each one is being progressive. And the current one we're in, I believe strongly, is in the early phases of a wave that moves on higher to $8. Tightening world supplies are a reality. Australia cannot save us with their crop in January, because the end users of world wheat are short bought and prices are needed. Now, I've been saying a lot and talking a lot about how wheat has a strong tendency to rally from the last week of September into the first week of November. That is the tightening of, moreover, a seasonal tendency. Let's go look at last year. September, we were moving higher well into the first of the year, but this September through November window, this area here on a timeline, obviously buoyed with a rally that occurred. Granted, we got rolling sooner. This 60-day cycle would have hit, if it wasn't for that August crop report, we probably would have declined into that 60-day cycle. But do note, I talk a lot about the 60-day cycle. It's not God. It's not perfect. But it sure scares you sometimes how perfectly it hits. Off a few days. Here, it was missed because the market was so bullish with the grain trade. When we got the December crop report on corn and beans, we just lit back up again, circumventing what was probably a high at the beginning of November and a decline in December. Last year, we had an early low because the August crop report was so bullish, but we still found this rally into November. Peaking obviously a little earlier, but overall the seasonal tendency was higher until we took off again before the start of January. Note off about a week or so here off about a week here, off about a week here, but still the general tendency of changing the trend, was there. Here too in January of 2020, we had an initial high that was gut checked by the middle of January, but still it won out and the market declined till past the opening of March of 2020. Oh yeah, take a look at this. September of 2019 was a low because July, if I would have carried the data here, July was a high and pushed higher into November, obviously peaked out a little earlier before circumventing the low, and maybe this arrow here should have been put here. And it was a push higher and it broke into the opening of November and then continued higher into January. The point of all this, we had a 60-day cycle low hit right at the onset of harvest and made a harvest low. Market did a post-harvest explosion rally, had broke into our 6-day cycle a day or two late and started another leg up. And I did note last week, we talked about this trend line. We said we could see a correction off this. Well, I'll admit I got a little antsy and I jumped in and bought Chicago wheat at 708 when it was trading discount to Kansas, thinking we were going to just do a shallow setback and move higher. Well, I'm wrong. So what we're getting is a larger setback off of this downtrend, but no off of that short-term downtrend, but the overall trend continues to remain up. And so with this, we look at the daily continuation chart. We have our cycle low. This is looking at it quicker. The last week's trend line went at 723, and conveniently, they found the news off of Russia, along with the news of Evergrande, which I believe will go away, to bust the grain market lower. And the break got us to a 618 on Kansas City versus a 786 break would have allowed for 682. But Chicago wheat went to the 786 retracement. And when you do these wave pullbacks, if this is wave one now, wave one was 40 cents in Chicago wheat, but it was 53 cents in Kansas City wheat. We did a 786 correction to wave two. Wave three will move higher and will be over 50 cents in length, likely over 40 cents. It'll likely be 50 cents in length, taking us to the 730, 740 area, which how conveniently butts up against this prior high resistance. But it'll work out in a series of legs. If you look at Minneapolis December wheat, it didn't rally as much as Kansas City, about 48 cents. Its break today was only 55% before hovering back near moving average support. So if we go to Kansas City wheat, and if we have this cycle low, and if our bottom is somewhere around today's 685 low, as you can see, the moving average would allow for 670. I do not think we'll get there. Maybe 681 would be the worst case on Kansas City on this pullback for a wave two. We will charge higher again. And I believe that we will see this cycle of activity move higher to the $8 valuation. And I think the stocks data on September 30th and the corn and soybean yields are going to start pushing this wheat market higher. And that's how $8 winter wheat prices are going to be achieved probably in November or December, and beans and corn will be pushing them there. Because, by the way, Brazil is dry. Argentina is dry. They're even waiting to plant the crop. It's so dry. But the National Oceanic and Atmospheric Administration gives an 80% probability of La Nina developing. Now, what I want you to see from this bean chart, for as bearish as so many want to be out there about how bad the exports were, how bad it is with Evergrande, oh God, China's going to buy no more beans, yet they bought probably 5 cargoes today, if not more. We're probably going to see something in the morning. What I want you to see from this chart, the ability to collapse, it's diminishing. It's diminishing. Look at, you would think with all the news we've had over the last several weeks, this thing would be down at $11.90 where all the techs are saying beans are going. Understand, the technicians say this is the bean market. I know they're out there talking. They're all talking $11.92 to $11.50. I hear them. Yeah, I know they're there. But they're wrong on this. Look at this basing action we're seeing here. This is amazing. If it's so bad, if Evergrande is so bad, why aren't we collapsing? We're not, because there is a natural bid that has showed up in this market that matches up with also the post June low when we pulled back again and held our long-term moving average. You just kind of see this bid. Seems like 1260 to 1270 is this bid in the market. Now, none of this that I'm telling you means squat dola as far as moving higher until we can prove the beans by at least closing above 1308 last week's high, which challenged at 1305. But look at all this resistance that comes in. This is the 50-day moving average. Look at your downtrend, 1320. This is your 125-day moving edge at 1339. So basically, in a nutshell, 1320, 1340. Until these beans get above that, and that's going to take either the stocks report on the 30th, shocking everybody, and or their actual yield data has come the 10th or 11th, 12th. I apologize. One of those days is the next crop report. But that's when the D-Day comes, and we will likely go into another uptrending market. And then when are we going to concern ourselves with South America? You know when it is? It's November. And that's when beans really get exciting, and they make a low right around the beginning of December, and all of a sudden they find some rain. I believe these beans are working out their low. They're not falling out of bed. They want to work something to the upside, but it's taking time. And it's going to take the USDA realizing and acknowledging what's happening out there. And at that, the crop was pushed too hard, and the rains weren't enough in late August, and they were almost non-existent in the Eastern Corn Belt to create yields that would justify anything near 51 bushel national average. Daily continuation chart. This I find interesting. Now remember, this is always your spot contracts rolling forward. Look at how this daily continuation chart, it's stopped the bean market. I missed this last week when it hit 1308. I didn't have this chart up on my computer and turned it back down again. But obviously, like I said on the prior chart, getting above 1305, 1308 short term, going to send this up into this 1340 resistance. You start going through 1340, something bigger is taking place, and your trend on a long-term position play has turned soybeans back up into the fall, into harvest. Can it happen? Yeah, look what happened last year. Beans rose all the way during harvest, and everybody was busy selling beans, and I was saying, no, they're going to 1080 minimum first, and then we worked the prices from there. Corn, today's 4 days down, but held well above the 200-day moving average. This is the 100-day exponential moving average, and as you can see, it stopped the corn market last week. 100-day simple would have put her up here at this price, but exponential is the one I've been because it's more true to what's been happening in here. Corn market down 4 days, held some good support. If you remember this chart, I showed you this last week, the 4 hour. I talked about this 515 range. It's kind of like you can just see this demarcation line, went down and hit it this morning and reversed higher off of that. We'll see if tomorrow can push back above it again and start another trend higher into the September 30th stocks report. This is Eugene Grainer with Heartland Investor Capital Management. Hope you find this information useful.